Long before balance sheets, income statements, or spreadsheets, accounting emerged from a far more basic problem. How do you remember who owes what and to whom when memory alone no longer scales? This segment begins not with modern firms, but with the moment economies outgrew face-to-face trust. Accounting is often misunderstood as a reporting tool, something that tells us what already happened. Historically, its role was much deeper. Accounting was a coordination technology. It allowed societies to organize labor, allocate resources, and sustain economic relationships across time, distance, and uncertainty. Early human economies were small enough that informal memory sufficed. A hunter remembered who shared meat. A farmer remembered who borrowed seed. But once production exceeded immediate consumption, once surplus appeared, memory broke down. Surplus demanded records. Records demanded structure. The earliest known accounting systems appear alongside the first complex economies in Mesopotamia. Clay tokens and tablets tracked grain deliveries, livestock counts, temple inventories, and labor obligations. These records were not abstract financial statements, they were operational controls. Accounting existed to ensure that resources flowed where they were intended, not to calculate profit. At this stage, accounting was inseparable from governance. Temples, palaces, and early states used accounting to manage collective projects, irrigation systems, granaries, construction, military provisioning. The question was not, are we profitable, but do we have enough? Enough food for winter, enough labor for harvest, enough materials for the next project. This framing matters because it reveals a core truth. Accounting arises wherever economic activity becomes too complex to oversee directly. As trade expanded, accounting evolved from inventory tracking into obligation tracking. Merchants operating across cities and seas needed to know not just what they had, but what they were owed, and what they owed others. Credit relationships multiplied. Time entered the equation. A transaction no longer ended at exchange, it extended forward into repayment. This is where accounting begins to resemble something modern readers recognize. Records now had to reconcile flows over time, not just stocks at a moment. Profit, in its earliest sense, was not an abstract optimization goal. It was simply the residue left after obligations were met and inventories replenished. Medieval commerce accelerated this shift. Long-distance trade required partnerships, shared risk, and delayed settlement. A merchant could be wealthy on paper and bankrupt in cash. Accounting's function expanded again, from tracking goods to measuring financial position under uncertainty. The pivotal conceptual leap came with the formalization of double-entry bookkeeping, most famously articulated by Luca Pacioli in the late 15th century. While Pacioli did not invent the system, he codified a method already in use among Italian merchants. Double-entry accounting did something radical. It treated every transaction as having two equal and opposite effects. Resources came from somewhere. Uses had sources. This was not merely a clerical improvement, it was an economic insight. It embedded the idea that wealth is relational, not absolute. Every asset corresponds to a claim. Every gain is mirrored by a change in obligations. In other words, accounting became a map of economic interdependence. From an economic perspective, this is the true function of accounting: to make invisible economic relationships visible enough to manage. Markets coordinate through prices. Accounting coordinates through records. Prices tell you what the market currently values. Accounting tells you how your past decisions constrain your future options. This distinction matters. Markets operate in the present. Accounting operates across time. A firm can survive poor pricing decisions temporarily if its accounting position is strong: ample reserves, manageable liabilities, stable cash flows. Conversely, a firm can appear successful in the market while quietly eroding its accounting foundations through hidden leverage, deferred costs, or mismeasured risk. Thus, from the very beginning, accounting served as the memory of the economic system. It preserved information that markets themselves cannot retain. By the end of this segment, one principle should be clear. Accounting did not emerge to maximize efficiency or profit. It emerged to prevent economic amnesia. Without accounting, surplus cannot be managed. Credit cannot scale. Organizations cannot outlive individuals. Complex production cannot persist. Accounting is not secondary to economics. It is one of its enabling conditions. In the next segment, we'll move from early commerce to industrial capitalism, where accounting shifts again from stewardship and memory into a tool for control, measurement, and managerial decision-making inside the modern firm. As economies moved from merchant trade to industrial production, accounting underwent its most consequential transformation. It stopped being primarily a record of exchange and became a system for managing production itself. This shift did not happen because theory demanded it. It happened because factories broke the old logic of business. Pre-industrial firms were simple. A merchant bought goods, transported them, and sold them. Costs were visible and discrete. Labor was paid per task. Materials were purchased per shipment. Profit could be approximated by comparing purchase prices to sale prices. Industrialization shattered this clarity. Factories introduced long production chains, fixed capital investments, continuous labor, shared machinery, time-delayed outputs. Suddenly, it was no longer obvious what anything cost. If a factory produced 10,000 identical units, how much of the steam engines where belonged to each unit? How should rent, supervision, maintenance, or idle time be assigned? These were not accounting puzzles, they were economic coordination problems. Accounting stepped in where markets could not. This is where cost accounting emerges as a distinct function. Its purpose was not external reporting. It was internal navigation. Managers needed answers to questions markets could not provide. Which products are actually profitable? Were costs rising faster than output? Are efficiency gains real or illusory? Should production be expanded, mechanized, or abandoned? Markets set prices at the boundary of the firm. Accounting set structure inside it. This distinction is central to understanding the firm as an economic entity. Within markets, coordination happens through price signals. Within firms, coordination happens through administrative decision-making, and accounting is the language those decisions are written in. This internal-external divide was later formalized by economists like Ronald Coase, who asked a simple but profound question: why do firms exist at all? The answer: firms replace market transactions with internal coordination when doing so is cheaper. Accounting is what makes that coordination possible. Industrial accounting also altered how time was treated. Earlier systems tracked obligations forward, who owed what and when. Industrial accounting had to allocate costs backward and forward simultaneously. Depreciation is a perfect example. A machine is purchased today but produces output for years. Accounting spreads its cost across time, not because this reflects physical reality perfectly, but because decision-making requires a usable approximation. Depreciation is not a measurement of wear. It is a tool for intertemporal discipline. This introduces a crucial idea that persists to this day. Accounting numbers are not neutral facts. They are structured estimates designed to support action. Once this is understood, many accounting debates become clearer. Different methods exist because different economic questions are being asked. The rise of managerial accounting also changed power dynamics inside firms. Workers, supervisors, engineers, and owners now interacted through numbers. Budgets, variance reports, and performance metrics allowed distant owners to monitor operations they could no longer personally observe. This was not merely efficiency-enhancing, it was organizationally transformative. Accounting made it possible to scale enterprises beyond personal oversight, separate ownership from management, standardize production across locations, compare performance across divisions. In effect, accounting turned firms into calculable systems. But this calculability came with trade-offs. What accounting measures becomes what management focuses on. What it ignores can quietly deteriorate. The famous tension between short-term cost control and long-term resilience begins here. By the late 19th and early 20th centuries, accounting had become an essential component of industrial capitalism. It no longer just recorded economic activity, it shaped it. Firms organized themselves around cost centers, profit centers, and capital budgets. Investment decisions depended on projected returns derived from accounting models. Strategy itself began to speak in financial terms. Accounting had crossed a threshold, from memory to measurement, from stewardship to control, from recording markets to structuring organizations. In the next segment, we'll follow accounting out of the factory and into the broader economy, where it becomes a standardized language for investors, regulators, and states, shaping how economic reality itself is defined. As firms grew larger and ownership spread farther from day-to-day operations, accounting faced a new challenge. How do outsiders evaluate an organization they cannot see? This segment is about accounting's transition from an internal managerial tool into a public economic language, one designed to make firms legible to investors, creditors, regulators, and eventually entire economies. Industrial firms required capital at a scale individual owners could no longer supply. Railroads, steelworks, utilities, and manufacturing conglomerates demanded massive upfront investment with long and uncertain payoffs. This gave rise to modern capital markets, and with them a new problem. Investors were asked to commit funds to enterprises they did not control, did not manage, and often did not fully understand. Markets cannot function on price signals alone when returns are delayed, risk is opaque, information is asymmetric. Accounting became the bridge. Its purpose expanded again, not to coordinate production, but to establish credibility across distance and time. This is where financial accounting separates from managerial accounting. Managerial accounting answers. What should we do next? Financial accounting answers. Can we be trusted? Balance sheets, income statements, and cash flow statements emerged as standardized narratives about a firm's condition. They condensed complex operations into interpretable summaries, not because reality is simple, but because decision-makers require comparability. This introduces one of the most important economic roles of accounting. Accounting enables capital allocation by reducing uncertainty, not eliminating it. A financial statement does not guarantee success. It provides a structured approximation that allows investors to compare alternatives. Without that structure, capital markets collapse into rumor, reputation, or speculation alone. Crucially, this function required standardization. If each firm reported performance differently, accounting would fail as a coordinating mechanism. What looked like profit in one firm might be a loss in another. Comparability demanded rules. This is why accounting standards arise not primarily from theory, but from collective necessity. In the United States, repeated financial scandals and market crashes culminated in the creation of the Securities and Exchange Commission, which mandated standardized reporting for public companies. These standards evolved into what became known as generally accepted accounting principles. Internationally, globalization created similar pressures. Capital flowed across borders, but accounting practices did not. To address this, many countries adopted or converged toward international financial reporting standards, aiming to harmonize financial language across economies. From an economic perspective, these standards serve a clear function: reduce information asymmetry, lower transaction costs, expand the pool of potential investors, increase market liquidity. Accounting standards are not about precision. They are about coordination at scale. However, standardization introduces tension. Rules that improve comparability can reduce relevance. A standardized method may obscure firm-specific realities. Conversely, flexibility can improve relevance but undermine trust. This trade-off between faithful representation and comparability is not a flaw in accounting. It reflects the underlying economic reality that no single measurement can serve all purposes. Accounting numbers, once again, are revealed as structured compromises. By making firms legible, accounting reshaped capitalism itself. Ownership became fragmented. Equity markets deepened. Pension funds, mutual funds, and institutional investors emerged, entities that could only function if accounting reliably summarized vast, complex organizations. At the same time, this legibility created incentives to manage appearances. Earnings smoothing, off-balance sheet financing, and aggressive revenue recognition are not aberrations. They are predictable responses to an environment where accounting numbers influence valuation, compensation, and survival. This sets the stage for a central theme of modern economics. When measurements govern behavior, behavior adapts to measurements. In the next segment, we'll explore this dynamic directly, examining how accounting both disciplines firms and distorts incentives, shaping everything from executive pay to macroeconomic stability. By the early 20th century, accounting had become more than a descriptive system. It had quietly evolved into a behavioral engine, a set of measurements that actively shaped how firms, managers, and investors behaved. This segment explores a central economic tension, the moment accounting stops reflecting activity and starts directing it. Once financial statements became the basis for valuation, creditworthiness, and executive compensation, accounting numbers acquired power. Profit, return on equity, and earnings per share were no longer just summaries, they became targets. From an economic perspective, this changes everything. When performance is judged by specific metrics, decisions cluster around what is measured. Unmeasured risks are deferred. Long-term resilience competes with short-term appearance. This is not moral failure. It is incentive alignment in action. Accounting turns complex organizational realities into simplified signals. These signals are necessary for coordination, but they inevitably distort behavior when treated as objectives rather than indicators. Consider the income statement. It compresses months or years of activity into a single number, net income. That compression is useful, but it hides timing, risk distribution, and sustainability. Managers operating under earnings pressure may delay maintenance, underinvest in research, or accelerate revenue recognition to satisfy reporting cycles. From the firm's internal perspective, these choices may appear rational. From the system's perspective, they can be destabilizing. This is where accounting intersects with economics most sharply. Accounting influences not just what we see, but what we choose to do next. Executive compensation amplified this effect. As ownership dispersed, firms needed ways to align managers with shareholders. Accounting metrics became proxies for performance. Bonuses, stock options, and promotions were tied to reported results. The logic was sound: reward those who increase firm value. The implementation was imperfect. Value is multidimensional, while accounting metrics are not. This gap explains why firms can meet financial targets while quietly eroding. Workforce capability, supply chain resilience, environmental and social capital, long-term innovation capacity. These costs exist economically, but not always accounting-wise, at least not immediately. The problem is not that accounting is wrong. It is that accounting operates on recognized and measurable dimensions, while economic reality extends beyond them. This limitation becomes most visible during crises. Before financial collapses, accounting statements often appear healthy. Assets are valued optimistically. Risks are dispersed across balance sheets. Leverage hides behind complex instruments. Accounting reflects the consensus of the moment, not the fragility beneath it. When conditions change, recognition catches up, but only after decisions are locked in. This lag is structural, not accidental. Economists have long recognized this dynamic. Frank Knight distinguished measurable risk from true uncertainty. Accounting handles the former reasonably well. The latter resists quantification. Similarly, Herbert Simon emphasized that decision-makers operate under cognitive and informational limits. Accounting systems exist precisely because full information is impossible, but they also define the boundaries of what decision-makers attend to. Accounting simplifies. Simplification enables action. Action creates blind spots. At the macroeconomic level, these effects compound. when many firms optimize around similar accounting metrics. Investment cycles synchronize. Risk accumulates system-wide. Short-termism becomes normalized. Accounting does not cause bubbles or crashes on its own, but it channels behavior in ways that can amplify them. This does not imply accounting should be abandoned. It implies it must be understood as a governance mechanism, not a neutral mirror. In the next segment, we'll zoom out further, examining how accounting frameworks shape national accounts, GDP, and the way entire economies define growth, productivity, and success. When accounting principles expanded beyond firms and into national systems, they did more than summarize economic activity. They defined what the economy is understood to be. This segment explores how accounting moved from corporate balance sheets to national accounts, and how that shift reshaped economic policy, measurement, and collective priorities. Modern macroeconomics depends on accounting identities. Long before sophisticated models or forecasts, economists needed a way to ensure that aggregate economic descriptions were internally consistent. National accounting provided that structure. At its core, national accounting answers a deceptively simple question. How much economic activity occurred within a defined boundary over a period of time? The most famous result of this system is GDP. While often treated as an economic outcome, GDP is fundamentally an accounting construct, a standardized aggregation of production, income, and expenditure flows. The logic is accounting logic. Output equals income. Income equals expenditure. One agent's spending is another's earning. These identities do not explain economic behavior, but they constrain it. They ensure that macroeconomic stories add up. The development of modern national accounts accelerated during the 20th century, particularly during periods of crisis and war. Governments needed reliable ways to assess productive capacity, mobilize resources, and plan large-scale interventions. The work of Simon Kuznets was foundational here. Kuznets helped formalize methods for measuring national income, but he also issued early warnings about misuse. He emphasized that national income was not a measure of welfare, and that confusing the two would lead to policy errors. Those warnings remain relevant. Accounting choices at the national level determine what counts as economic activity. GDP includes market production, government services, investment and consumption. It largely excludes household labor, environmental depletion, informal care work, long-term ecological damage. These exclusions are not accidents. They reflect the same constraints seen at the firm level. Accounting captures what is measurable, monetized, and exchange-based. From an economic perspective, this creates powerful incentives. Policies optimized for GDP growth favor activities that register cleanly in accounts, even if they degrade unaccounted resources. Environmental extraction boosts output today while leaving future costs invisible. Preventive care may reduce long-term costs but appear as immediate spending. Once again, measurement shapes behavior. National accounting also influences how governments perceive constraints. Budget deficits, public debt ratios, and fiscal sustainability are framed through accounting relationships. These frameworks are indispensable for planning, but they also narrow the policy imagination. A government may face accounting constraints that appear binding, real resource constraints that are less visible, political constraints that dominate both. Confusing these layers can lead to austerity during periods of underutilized capacity or excessive stimulus when bottlenecks exist. Accounting does not dictate policy, but it strongly frames what policymakers believe is possible. Internationally, standardized national accounts enable comparison between countries, but at a cost. Economies with different structures, demographics, and informal sectors are evaluated using the same templates. This improves coordination, but can misrepresent lived economic reality. Just as firms manage earnings to meet expectations, nations manage statistics to signal credibility to investors and institutions. The incentives are similar, only the scale differs. The key insight of this segment is continuity. The same forces that shaped accounting inside firms, standardization, comparability, incentive effects, also operate at the level of entire economies. Accounting does not merely describe economic reality. It participates in its construction. In the next segment, we'll return to the firm, but in its modern form, examining how contemporary accounting interacts with finance leverage and the growing gap between economic risk and accounting recognition. As economies became more financialized, accounting encountered a new and persistent challenge: how to represent risk that is real but not yet realized. This segment focuses on the growing tension between economic exposure and accounting recognition, especially in systems dominated by leverage, complex financial instruments, and interlinked balance sheets. In traditional industrial firms, most risks were operational. Machines broke, workers struck, demand fluctuated. These risks were visible, local, and often gradual. Accounting, even with its limitations, could keep pace. Modern economies shifted risk into the financial layer. Leverage allows firms to control large assets with relatively small equity bases. Financial innovation allows risks to be sliced, repackaged, and distributed. Balance sheets grow more complex even as underlying operations may remain stable. From an economic perspective, this creates a mismatch. Risk accumulates continuously. Accounting recognizes losses discreetly. Accounting records losses when thresholds are crossed, defaults occur, assets are impaired, markets reprice. Until then, exposure can remain largely invisible. This is not deception by default. It is a structural property of recognition rules. Consider fair value accounting. Marking assets to market improves transparency when markets function smoothly. Prices aggregate information and signal consensus valuations. But during periods of stress, markets can freeze or overshoot, forcing abrupt revaluations that amplify volatility. Conversely, historical cost accounting smooths fluctuations but can mask deterioration until it becomes unavoidable. Neither approach is universally superior. Each trades responsiveness for stability. The economic lesson is simple. Accounting frameworks manage trade-offs. They do not eliminate them. Financial institutions sit at the center of this tension. Banks, insurers, and investment firms operate almost entirely through balance sheet relationships. Small changes in asset values can have outsized effects on solvency due to leverage. Yet many of these exposures are probabilistic rather than certain. Accounting struggles with probability. Expected losses can be estimated, but uncertainty, especially systemic uncertainty, resists clean representation. Stress tests, reserves, and capital requirements attempt to bridge this gap, but they remain models layered atop models. When confidence holds, accounting appears robust. When confidence breaks, recognition accelerates faster than adjustment. This dynamic was visible during major financial crises, where balance sheets appeared sound shortly before rapid collapse. Accounting did not fail. It operated exactly as designed, within limits imposed by uncertainty and timing. This gap between economic reality and accounting recognition has policy consequences. Regulators rely on accounting data to assess stability. Firms rely on accounting signals to guide leverage decisions. Investors rely on reported metrics to price risk. When all three rely on similar representations, blind spots align. Systemic risk emerges not from individual misstatements, but from collective dependence on the same accounting abstractions. From an economic perspective, the function of accounting here is paradoxical. It enables vast financial systems to operate by simplifying complexity, but that same simplification can delay recognition of accumulating fragility. Accounting supports scale while constraining foresight. This is not an argument against accounting. It is an argument for humility in how its outputs are interpreted. By this point in the series, a pattern should be clear. At every scale, households, firms, markets, nations, accounting enables coordination, shapes incentives, simplifies complexity, introduces blind spots. In the next segment, we'll explore how modern accounting attempts to respond to these limitations through expanded disclosures, non-financial reporting, and attempts to measure what was once considered unmeasurable. As the gap between economic reality and accounting recognition widened, pressure mounted to make accounting say more than it comfortably could. This segment examines modern efforts to expand accounting's scope without fully abandoning its core discipline. The question driving these efforts is simple. What matters economically but does not appear cleanly in financial statements? Traditional financial accounting is intentionally narrow. It focuses on transactions that are monetized, attributable to a specific entity, realized or reasonably estimable. This narrowness is not a flaw, it is what makes accounting reliable. But as economies evolved, it became increasingly clear that some of the most consequential economic forces operate outside those boundaries. Environmental degradation, workforce stability, data governance, supply chain resilience, and institutional trust all shape long-run value creation. Yet most of these factors enter financial statements only indirectly, and often too late. Rather than rewriting accounting from scratch, modern systems responded by layering disclosure on top of recognition. This is where expanded reporting frameworks emerge. Environmental, social, and governance disclosures, commonly grouped under ESG, are not accounting statements in the classical sense. They do not obey double-entry logic. They do not reconcile perfectly. Instead, they function as contextual supplements to financial reports. Their economic role is informational rather than allocative. ESG disclosures attempt to surface risks and dependencies that financial numbers alone cannot express, at least not until consequences materialize. To bring structure to this growing domain, institutions like the International Sustainability Standards Board were created to standardize how firms report sustainability-related risks and opportunities. The goal mirrors earlier accounting standardization efforts: improve comparability, reduce noise, and make disclosures decision useful. Similarly, frameworks such as integrated reporting aim to connect financial performance with non-financial drivers, human capital, natural capital, and organizational capability, without forcing them into inappropriate monetary form. From an economic standpoint, these efforts represent a recognition of limits. Not everything that matters can be priced today, but ignoring it entirely distorts capital allocation. However, expanded disclosure introduces new tensions. Standardizing non-financial information risks false precision. Metrics may appear rigorous while resting on fragile assumptions. Firms may optimize narratives rather than realities. Disclosure volume can overwhelm users without improving insight. Once again, incentives matter. When ESG metrics influence capital access or valuation, firms adapt, sometimes substantively, sometimes cosmetically. The same behavioral dynamics that shaped financial accounting reappear in new form. This does not invalidate disclosure. It underscores that measurement is always an intervention. Economically, the role of modern disclosure is best understood as early warning signaling. Financial accounting excels at recording realized outcomes. Disclosure attempts to illuminate dependencies before they break, risks before they crystallize, trade-offs before they become irreversible. But disclosure does not resolve uncertainty. It merely shifts when and how uncertainty enters decision-making. Markets still interpret. Managers still prioritize. Policymakers still face constraints. At this stage, accounting resembles a layered system. Core financial statements provide disciplined, auditable structure. Disclosures provide breadth and forward-looking context. Judgment mediates between them. The system remains imperfect, but it is adaptive. In the next segment, we'll look directly at the present and near future, how digitalization, real-time data, and algorithmic decision-making are reshaping accounting's function inside firms and across economies. Accounting is no longer a periodic activity. It is becoming an always-on system, embedded directly into the operational core of firms and markets. This segment examines how digitalization changes accounting's economic function, from retrospective reporting to continuous coordination. Historically, accounting lagged behind activity. Transactions occurred first. Records followed. Reports arrived weeks or months later. This delay was tolerated because production cycles were slow and decisions were reversible. Digital systems collapsed that gap. Enterprise platforms integrate purchasing, inventory, payroll, logistics, and finance into unified data structures. A sale updates revenue, inventory, receivables, and forecasts simultaneously. The ledger is no longer a book, it is a live model of the organization. From an economic perspective, this is a structural shift. Accounting moves from after-the-fact memory to real-time constraint management. This transformation alters managerial decision-making. When costs, margins, and cash positions update continuously, decisions adjust faster, but also more narrowly. Managers respond to dashboards rather than deliberation. Variance becomes visible instantly, increasing pressure to correct deviations even when patience would be optimal. Speed improves responsiveness. It can also compress strategic time horizons. The firm begins to behave like a cybernetic system. Inputs measured, outputs adjusted, deviations minimized. Accounting becomes the feedback loop. At the same time, automation reduces the discretionary space once occupied by human judgment. Rules-based recognition, standardized workflows, and embedded controls make accounting more consistent but less interpretive. Judgment does not disappear. It migrates upward into system design and parameter selection. Who decides? Recognition thresholds. Capitalization rules. Risk weights. Forecast horizons. These choices shape outcomes long before numbers appear on reports. Economically, this reinforces a recurring theme. Accounting power shifts from interpretation to architecture. Digitalization also blurs boundaries between accounting and analytics. Forecasting, budgeting, and performance management increasingly rely on predictive models layered atop accounting data. The distinction between what happened and what is expected narrows. This has benefits. It allows firms to anticipate constraints rather than react to them. But it also embeds assumptions deeply into systems, assumptions that may go unquestioned because outputs appear objective. Opacity shifts from numbers to code. Some proponents argue that distributed ledgers and immutable transaction records will eliminate trust problems. While such systems can improve verification, they do not remove judgment from accounting. Valuation, classification, impairment, and aggregation still require interpretation. Technology can secure records. It cannot decide meaning. From an economic standpoint, digital accounting systems reduce transactional uncertainty, but they do not resolve economic uncertainty. At the macro level, real-time accounting data tempts policymakers with new forms of intervention. Faster indicators promise faster responses. Yet rapid feedback can encourage overadjustment, mistaking noise for signal. The danger is not lack of data, is excess immediacy. Economic systems benefit from information, but they also require slack, buffers, and tolerance for deviation. Accounting systems that eliminate delay may unintentionally eliminate resilience. By now, accounting's role has clearly expanded far beyond bookkeeping. It is a control system, a decision architecture, a behavioral signal generator, a coordination mechanism across scales. In the next segment, we'll step back and ask a harder question. Given everything accounting does and fails to do, what is its proper role in a healthy economic system? After tracing accounting from clay tablets to real-time systems, a deeper question emerges, not how accounting works, but what role it should play in a functioning economy. This segment reframes accounting not as a technical craft, but as an economic institution with a specific purpose and a specific set of limits. Accounting succeeds when it imposes discipline without pretending to be truth itself. At its best, accounting constrains action. It forces trade-offs into view. It prevents wishful thinking from passing unnoticed. It makes commitments visible and resources finite. But accounting fails when its outputs are treated as complete representations of economic reality. This tension is unavoidable because accounting operates under three permanent constraints. Information is incomplete. Uncertainty is irreducible. Measurement changes behavior. No refinement of standards or technology removes these conditions. From an economic perspective, accounting's core function is not optimization. Markets handle optimization imperfectly, but dynamically. Accounting's role is governance across time. It answers questions markets cannot. What obligations already exist? How much flexibility remains? What future actions are constrained by past decisions? Accounting anchors decisions in accumulated consequence. This anchoring function explains why accounting is conservative by design. Recognition rules require evidence. Losses are recognized faster than gains. Uncertainty is discounted. These features frustrate those seeking precision, but they protect against overextension. Conservatism is not pessimism. It is a structural bias toward survivability. When accounting abandons this bias, chasing relevance, speed, or completeness, it risks becoming speculative. When it becomes speculative, it ceases to govern and starts to amplify cycles. Economically, healthy systems exhibit plural measurement. Accounting should coexist with market prices, physical indicators, institutional knowledge, qualitative judgment. No single system should dominate. Problems arise when accounting becomes the sole arbiter of success. When organizations collapse diverse realities into a few headline metrics, they narrow their own adaptive capacity. The lesson is not to reject measurement, but to resist measurement monoculture. This perspective also clarifies why accounting reform is perpetually contested. Every proposed change shifts incentives. Every new metric elevates some risks and suppresses others. Every standard encodes values about what deserves recognition. Accounting debates are not technical squabbles. They are economic governance debates conducted through numbers. At the end of the day, accounting does something profoundly human. It acknowledges that we act before knowing outcomes. We commit resources under uncertainty. We must live with the consequences. Accounting is the structured memory of those commitments. In the final segment, we'll bring the story to the present moment, examining how accounting's future will likely evolve and what economists, firms, and societies should realistically expect from it going forward. Accounting's future will not be defined by perfect measurement, real-time precision, or total transparency. Those goals are tempting, but they misunderstand what accounting has always been for. This final segment brings the thread together by asking not what accounting could become, but what it must remain if complex economies are to endure. Every major expansion of accounting's scope has followed the same pattern. First, economic complexity increases. Then coordination breaks down. Then accounting adapts, imperfectly, conservatively, and just enough to restore order. This pattern will continue. As economies confront climate constraints, demographic shifts, technological acceleration, and geopolitical fragmentation, pressure will grow to make accounting capture everything. More metrics, faster reporting, deeper integration with forecasting and automation. Some of this expansion is necessary. Much of it is risky. From an economic perspective, accounting's greatest contribution is not foresight, it is restraint. Accounting reminds decision-makers that resources are finite, commitments accumulate, flexibility erodes quietly, past choices narrow future options. No algorithm replaces that discipline. No dashboard eliminates trade-offs. The danger in the coming decades is not that accounting will be too conservative, but that it will be asked to justify action rather than constrain it. Future accounting systems will likely evolve along three paths. First, greater integration with operational and non-financial data. Accounting will sit closer to production, logistics, and environmental systems, not to monetize them fully, but to make dependencies visible earlier. Second, increased emphasis on scenario-based disclosure rather than point estimates. Recognition will remain cautious, but reporting will widen to reflect uncertainty ranges rather than single outcomes. Third, stronger separation between measurement and decision-making. Healthy systems will resist turning accounting outputs directly into automated action, preserving human judgment at key thresholds. These developments do not promise clarity. They promise durability. At the societal level, economic maturity may be measured by how accounting is used. Immature systems treat accounting as proof of success. Mature systems treat it as a warning system. Immature systems chase growth through metrics. Mature systems monitor sustainability through constraints. Accounting cannot create wisdom, but it can protect space for it. If there is a single lesson running through this entire series, it is this. Accounting is not about knowing the future. It is about remembering the past clearly enough to act responsibly in the present. From clay tablets to digital ledgers, accounting has always been an institutional memory, quiet, imperfect, and indispensable. When it does its job well, nothing dramatic happens. Firms persist, markets adjust, economies endure, and that, in the long run, may be its most valuable function of all.